In this video, we're going to talk about how taxes influence the cost of capital. In our formula, as you see, there is a pre-tax weighted average cost of cap formula that has the proportions of debt to the cost of equity and the cost of debt. From that, then, we need to subtract the tax shield. And if you remember our formula, it's T sub C, the corporate tax rate, times the cost of debt, and here's the proportion of debt. So again, as the proportion of debt goes up, this part declines, obviously, and that would reduce the weighted average cost of capital. If we expand this algebraically, we end up with just the proportion of equity times the cost of equity, the proportion of debt times the after-tax cost of debt. R sub D, that cost, times 1 minus the tax code. So what this implies then is as the cost of debt increases, or as more debt in the capital structure increases, eventually, of course, the cost of debt does increase. But we also see, as we had before, that the cost of equity is going to increase because of the increase in risk. But because of the reduction in the cost, because of taxes, the weighted average cost of capital is actually going to decline eventually. So again, if we go back to our formula, if the weighted average cost of capital declines, that must mean that the value of the firm goes up. So we have a company, they have free cash flow of $4.25 million. It's going to grow at 4% a year. Equity cost capital 10%, debt 6%, corporate tax rate of 35%. They have a debt equity ratio of 0.5. So what is the value of the interest tax shield? So the pre-tax weighted average cost of capital, again, just the weights times the costs, 8.67%. Because their free cash flow is expected to grow at a constant rate, we can plug it into our formula. We end up with $91 million is the cost pre-tax. But once we apply taxation, that now moves to what? 7.97 is the weighted average cost of capital, changes the value to $107 million, which means that the present value of the interest tax shield is the difference. 107 minus 91, so we have $16 million is the present value of the interest. So again, our new graph here shows that the value of a levered company, V sub L, equals V sub U plus T sub C times D. So again, as we increase debt, this particular theory, let's just call it Modigliani and Miller with taxes, increases in value by TC for every dollar of debt. Now, if we want to adjust our leverage, obviously it has an impact on the V sub L. So it's going to have a change in the weighted average cost of capital. So here we have Midco. They have 20 million shares, $15 is the price. They have zero debt. They have earnings, they have a 21% tax rate, and they plan to borrow $100 million on a permanent basis, and they're going to repurchase some shares. So without leverage, the value unlevered, $300 million. 20 million shares times $15 a share. They borrow $100 million, right? So the present value of that tax, right? TC, 21% of $100 million, that's $21 million. So the total value of the levered firm is going to be $321 million. because the value that is 100 million, the value of equity then is 221 million. Again, even though the value drops, don't forget that the shareholders also received money from the repurchase. So they're receiving a total of 321 million. That's more, right? That's a gain of 21 million over the value of their shares without leverage, right? So they got the increase, in fact, even a greater increase when the company increased its capitalization with respect to debt. What if they repurchase its share at the current price? Be 667, then they'd have 13.3 million shares outstanding, right? That'd be what would be left. The total value of equity is 221 million. Divide that by the shares. It's 16.57 is the new value of the company. It used to be $15. So again, not only did the value show an increase, we also saw an increase in the stock price. Again, that total, if you multiply that by the number of shares, again, that's $21 million. We seem to be repeating ourselves here for these last couple of slides. But again, the question that they ask here is kind of a good question. If the shares are worth $16.58 after the repurchase, why would anybody tender their shares at $15? Well, the question is, who knows about this transaction, right? If nobody knows about the transaction except for the company, right, it's private information, then the price should stay $15. It's when people find out about the transaction, right? That's when the price changes. So again, the value of the equity could actually change pretty quickly, right? So it could go to 1605, which means, again, 321 million is the end value by 20 million shares, $16.05. Again, it's still $1.05 more with the repurchase, even at that $16.05. So again, when securities are fairly priced, the original shareholders get the full benefit of the interest tax shield when there's an increase in leverage. Now we're going to talk about this a little bit later on when we add and incorporate other variables into this discussion. But for right now, the Modigliani and Miller with taxes says, in order to increase the value of the company, you need to recapitalize it in a way that will increase the debt equity ratio. Look forward to talking to you in the next video.